Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Christmas Eve, the 24th of December 2021. As always, this is general commentary and doesn't take your personal situation into account. Alright, with all that said, let's jump over to the first chart. Okay, well it's the S&P 500. And yeah, look, it's been a pretty interesting week. We got some bearish feeling selling early in the week. We can just see through here. That was pretty much on Monday morning local time, in the Sunday evening session in the US. And around sort of like Monday, Tuesday, I started seeing some concerns, some bearish concerns about the markets generally. This whole Omicron sort of fears were coming to the fore, and people were concerned that maybe we're going to see some more follow-through selling and that maybe we're going to get a bit of an ugly week. But look, that earlier weakness really didn't amount to too much. The US markets opened on Monday night and have been trading higher ever since. So it is interesting because the price action that we've been seeing through this section here really didn't support the notion that we were going to get a big sell-off just at this point. I'll come back and talk a bit more about that in a moment, because it is interesting to sort of look through the price structure for trying to understand where markets might be going. But like on this chart on its own at the moment, look what appears to be happening here. It looks like maybe we're getting a triangle formation developing on the charts. So let's just draw that in. And now what I want to do, so we've had this big run up from the October lows and the consolidation we've been having. And for these patterns to form, it takes a bit of price action, takes a little while for the picture to start to firm up. But this is the way it's now appearing. It does look like we've got that pattern. So I want to jump over to the 4-hourly chart. You'll probably know if you've been watching these for a while. I like these 4-hourlies and hourly charts. It just gives you more internal structure to the price action and can help you see these patterns better and can give you better ideas of how it's all shaping up. So look, the way this could play out. So getting up towards the upper bounds of this triangle, we're coming into the Christmas to New Year week where trading is likely to be, trading will be probably light, and it could very well stall up around here for the next few days. So it's possible we see the market just sort of like chop around. But look, I've got to say the odds favour that after that we do get a break to the top side. It's I think our base case at this stage has to be that the bulls remain in control of the market, and the odds favour that we are going to see higher levels. I think that's going to be the case. So let's jump over and check out the Nasdaq. So we'll just go back over to a daily to start with and get our Nasdaq chart. Okay, so Nasdaq is interesting as well. So I want to start by putting on put the Fibonacci's on. These are always a good way to sort of look at how the market is performing when you do having a consolidation or a pullback period. And we can see that bounce from last week came pretty much right on the 50% retracement. And we'll kick straight back up to just below these previous highs. I had a question last week. I was asked, how do you work out where to measure your Fibonacci's from? It's like I've been doing this for so long, it's just second nature where to do it from. But I can completely understand that you may be watching this go, well, why those points? So what I've done for this one here, I'm using the low here, and I'm using the high here. So the Fibonacci's often tie in with Elliott wave theory. Use Fibonacci's a lot in the Elliott wave. I'm not really using it in Elliott wave format, but I have studied it a lot previously, so it just sort of comes naturally where to put them. So the idea is that with these Fibonacci's, you're measuring what appears to be a complete move. And so, for instance, so to me, this looks like a strong move that started here, finished there. So you can also measure intervals within a move. So, for instance, we could measure from here to here, like that looked like one interval within this larger move up, and you can see it actually worked quite well. It came back to the 61.8%. Then you could say from this point here to this point, that looks like a complete internal move within this larger upward move. In this case, you can see it's a bit hard to see with the other one there, but didn't quite come back to the 38.2. What you don't want to do when you're doing Fibonacci's is you don't want to be sort of like measuring partial moves. So like, starting it from here and then going up to there wouldn't make as much sense. You don't get it. It just doesn't quite work. It's meant to be, you're meant to be doing it on completed moves, not partial moves. And you can do it on just to give you an idea. Like I could do a whole video on this. I don't want to stay too long here because it's a lot to get your head around. Like for instance, so this section through here, like you could say you'd do your Fibonacci from this point through to this point. That could be a whole move. But I see that as a zigzag correction, and then I'd say the new up move started from this point. So then I'd measure from there. Not engaging. There we go. Measure from there to there, and then that worked. That picked up the low before we got a rally. So look, it's one of those things which isn't an exact science. It's very much open to interpretation. But once you develop your chart eye and you develop a feel for these things, they can be very useful in working out pullbacks and consolidations. Okay, so we got a little bit sidetracked there, but look, it's an interesting thing to look at, and I will talk more about this another day. So okay, so let's jump over to the 4 hourly chart. Just a little bit more detail on this. Okay, so let's take our Fibonacci's off. I said I was going to talk about how the internal structure didn't look like we're going to get like a big sell-off this week. And I'll tell you what I meant by that. I'll look at this move up through here. Look at this move from the low to the high. I see this as very much an impulsive structure. And by impulsive, I mean the up moves are strong and the consolidations are basically sideways. And there's not much internal overlapping between the up moves and the consolidations. So for example, just get rid of that. For example, say this pullback, you had a pullback there, and it didn't come back and it didn't overlap with that high there. And there is overlap sort of through here, but this is all part of. There's all different ways you can explain that, but generally you've got this impulsive move where the pullbacks are relatively shallow and it pushes higher. Here's quite different. Here is quite overlapped. So we had this move down, which looked fairly impulsive, and it could have been setting up for something which could have turned into a larger decline. But then we had this strong move here, and what this move here does, it then overlaps with all this price action through here. So the whole down move loses its momentum. Then we had another sell-off. The sell-offs are sharp, but they're quite jerky. And then we had another strong rally, so we've got more overlap. So this whole move then starts to become very overlapped and very corrective looking. So you get impulsive moves, you get corrective moves. A bear market or a larger decline is less likely to come from a choppy overlap move like this. This is more likely to be a consolidation before a market moves higher. So that's just a little bit of how these markets can shape up. So just looking at what we've got on the Nasdaq now, we've come back up to resistance around here. coincides with the top of the triangle in the S&P we were looking at a moment ago. So look, the next few days, this resistance is, I think the odds would favour, is going to hold the market. Maybe we're going to see just a little bit of consolidation beneath it. But again, I think the odds favour that that's what we're going to get, that we are going to get a punch up above that resistance point. Where to from then? Well, I don't know. I think there's definitely warning flags with this market, which we spoke about last week. There's the number of stocks above their 200-day moving average has been weakening. There's divergence between some of the markets, like the Dow is a bit further from its highs, whereas the S&P is close to it. There are some warning flags in this market, but rather than trying to pick a top, I think the strategy is you go with the trend. The trend at this point is up, and we just need to see where the bulls are going to take this market. Just briefly, very briefly, on the Russell 2000. Last week we were talking about how the market had come back to support, which is located roughly round about here, and we talked about that. It didn't look like, with everything else we were putting together, all the pieces we were putting together, it didn't look like it was going to have the momentum to punch through that support, and we said that a bounce was the most likely outcome. And look, that's very much what we've had. We've had a bounce off this. I don't know what happens from here. We're just going to have to wait and see. It's look, if that pattern, the S&P continues to take shape and the Nasdaq punches to a new high, we're probably going to see the Russell move higher as well. It's very much in the middle of a trading range now, so it's a matter of just wait and see what happens, whether it forms a base to have another launch higher. We just got to wait and see. Need more information there, but look, it has done what we thought last week. It's bounced off support. It's neutralized any bearish sort of scenario that was building for a near-term breakdown, and let's see where that goes over the next couple of weeks. So just jumping over to the Aussie market, looking at the S&P 200. Okay, let me just jump back to our daily chart to start this off. And last week we were talking about this triangle, which is really becoming really a clearly defined pattern. It's really interesting. And it's been an interesting week because despite some of the nervousness which I've been observing in the market, you can see how well the S&P the ASX 200 has held up. It's actually had it's actually broken to the top side of this pattern. And we were talking last week how it was talking about how, like the textbook type triangle would form, like we talked about. It's got five components to it, which we count through letters. And this is, again, it morphs back to this Elliott wave theory. So we've got the A, the B, the C, the D, the E. This is kind of where we left it last week, and we said if it's textbook, it would stop there and it would rally towards the resistance, and that's what it's done. So if it's going to keep going textbook, which who knows whether it does, because if everything was textbook, you wouldn't have too much trouble making money. But everything isn't textbook. But it's just trying to work around theory and managing risk and spotting possibilities and applying strategies. So if this were to play out, you might get some sort of consolidation or return move there just above the breakout point before another rally, and maybe that will take the ASX 200 to a new all-time high. At this stage, I would say the odds favour that is what's going to happen, that we will see a new high in the ASX 200 in possibly January. So interesting. Let's wait and see what happens. Now, I've got one more chart I want to show you. And by the way, if you're enjoying this and you're getting some value, please hit the like button as always. And please leave a comment. Just a short one is good because it tells YouTube that people are engaging. That helps me. So that'd be great if you could do that. Just, thanks for the video. All you need to do, or say more if you'd like to tell me more. That would be good as well. And also, if you haven't, hit the subscribe button with the bell icon so you get the notifications. All right, okay, last chart for the year. So this is a stock from my Motion Trader subscription service, and this is one the system got wrong, and it gets things wrong. That's just how trading works. But so let me just take you through this. So it's a stock called Magellan Financial Group. It appeared in the news this week. It had as you can see here, it had a big down day. It had a 30% down day. It's a big ASX 200 stock. A lot of people follow it, and it got hit really hard on some negative news. So just winding the clock back. So here, these are the moving averages I watched, 50 and the 100 day. So we had the moving average crossed over, and it looked like after a period of declining prices, some base building, we started to turn higher. The conditions were right for a potential upward trend to start. Now, not every upward trend will kick on and become a strong trend, but it's all about looking for possibilities and then managing risk around those. So it triggered a buy signal. But look, this one petered out pretty quickly. It lost momentum, started to roll over. All of the stocks which I follow will have an exit stop. So everything Motion Trader, my service, will find a buy signal for, will have an exit stop. And so Magellan came back and hit the exit stop. The idea is to give it plenty of room to move around, to try and engage that upward trend. But if it's not engaging, you get out of the position. Walk away, minimize your loss, apply your capital elsewhere. A lot of people don't like to do that. A lot of people like to persist, and they say, I don't like red, I don't like getting out at a loss, I won't sell. And I hear this all the time. And people tell me, they say, I won't subscribe to your service because you take losses. I don't like losses, I like to hold. Look, there's all sorts of ways to trade the market, but I think holding a falling stock after a particular point is dangerous, because it's not the ones that get to here and then come back that cause you the trouble. It's the ones that get to here and they continue down and then they accelerate lower. They're the ones that can ruin your portfolio and be a dead weight within your portfolio for, could be months, could be years, it could be permanent. Like, who knows where Magellan goes from here? Some stocks go to zero. It's not a prediction for this company by any means, but we just don't know, and that's the point. You don't know where a stock's going to go, so you've got to have an exit strategy to protect your capital, so you then can reallocate it elsewhere. And the other side to this is that people who like to buy the dip. Buying the dip is, look, it can be a great strategy, but I think if you're going to buy the dip, you really got to understand the overall price structure of a chart. You've got to be good at understanding the nature of a move. Like we spoke about earlier, understanding the structure of the NASDAQ, how we had an impulsive move, then we had an overlap, corrective, consolidative look move. So if you're going to buy the dip, you buy a move that looks corrective and like it's consolidating, that it's overlapping. You don't buy a move like this, which starts looking impulsive to the downside, where it's gathering steam. That's just putting yourself in front of the steamroller, and you're destined to get run over at some point, and that ain't what you want. So look, I think buying the dip's a dangerous strategy, but if you're buying consolidations, like we were speaking about before, you can use the Fibonacci's for like points, like the 38, the 50, the 61.8%. And but look, if you're not comfortable with that, if you're not confident with that, and if you're in doubt, I think the way is you use your moving averages and you buy stuff which is going up. On this occasion, it hasn't gone up, but look, lots of the time stocks do. So if we just wind this back a bit, and like here's another buy signal I had in Magellan a while ago, is 2019. Moving averages turned, the stock was gaining momentum, and this ran for a long way until it eventually hit the trailing stop. So it's like you let your winners run and you cut your losses relatively early. That's how I do it, and that's how a lot of really successful traders and investors operate their portfolios. All right, well look, that's a wrap for this year. I'm going to take a break next week. I'm going to take a week away from it all. Then I'll be back with another video in 2 weeks' time. So thanks for joining in. Thanks for being part of Trade the Trend this year. Have a good break yourself, and look forward to speaking to you again soon. Bye for now.